Rivian stock price targets, UiPath stock analysis, and Velo3 stock news updates. Hey, welcome back to our channel. Today, we've got an exciting lineup for you as we dive into the world of stocks and market updates. We'll be discussing three fascinating articles that are making waves in the investment world. First, we'll look into the skyrocketing success of Rivian with ticker symbol RIVN stock and discover why it's currently going higher. Then we'll go deep into UiPath or Path to see if it has the potential to become the next Salesforce, a game changer in the tech industry. Last but not least, we'll keep you up to date on the latest Velo3D with ticker symbol VLD developments and how they're addressing the problems of a soft demand environment. Let's get started. Why Rivian stock is riding higher today? First, we're diving into the exciting world of Rivian with ticker symbol RIVN stock and finding out why it's riding higher today. So, what's causing the surge in Rivian stock price? Well, it seems like analysts are singing some bullish tunes about this electric pickup truck manufacturer. Needham analyst Chris Pierce is maintaining his buy rating on Rivian and even raised the price target to $31 from $28. That's a 19% upside potential based on the stock's closing price on Thursday. But that's not all. Tigress Financial is also joining the optimism party by increasing its price target to $36. Analyst Ivan Feinseth believes that Rivian's increasing production and deliveries, along with growing efficiency, will pave the way for significant revenue growth and a path to profitability. Sounds promising, right? Now here's where the things get interesting. Ford, the automotive giant, made some waves with its second quarter presentation, highlighting the shift to powerful digital experiences and breakthrough electric vehicles or EVs. And you know what that means. Competition in the EV space is heating up, especially with Ford's all-electric F-150 Lightning pickup truck in the mix. But here's the twist. Rivian investors seem to be taking Ford's commentary with a grain of salt. They might not see the pressure from Ford as formidable as they once thought. Perhaps Ford's decision to cut the price of the Lightning F-150 earlier this month has something to do with it. Whatever the case, Rivian investors are feeling optimistic about the company's prospects. Now, before we get carried away, let's keep things in perspective. While there are valid reasons to be interested in Rivian stock, the recent price target hikes and Ford's commentary alone might not be enough to hit that buy button just yet. As smart investors, we should stay laser focused on what Rivian has to say when they report their second quarter financial results in the coming days. Could UiPath become the next Salesforce? Now, let's talk about the potential of UiPath with ticker symbol PATH or PATH, negative 2.16%, becoming the next Salesforce in the software market. You know how Salesforce revolutionized customer relationship management or CRM by ditching those old Rolodexes and desktop-based software and moving to the cloud. Well, that move skyrocketed its revenue from $51 million to a whopping $31.4 billion between fiscal 2003 and 2023. Talk about impressive growth. 38% compound annual growth rate or CAGR. But here's the thing. As Salesforce matures, its growth is cooling off, and that has growth-oriented investors on the hunt for the next Salesforce. Enter UiPath, the leader in robotic process automation or RPA. UiPath develops software robots that automate repetitive tasks like data entry and processing invoices, cutting costs and streamlining operations for companies. With a first-mover advantage, UiPath controls 34% of the global RPA market as of 2021, according to Gartner. That's a significant chunk. And it expanded its share further last year, while its smaller rivals lost ground. Impressive, right? But can UiPath scale up its business and follow in Salesforce footsteps? Well, from fiscal 2020 to 2023, its revenue soared with a CAGR of 47%, reaching $1.06 billion. But compared to Salesforce's $1.08 billion in revenue in fiscal 2009, UiPath's growth rate seems a bit more subdued. Analysts predict a CAGR of 19% for UiPath from fiscal 2023 to 2026, which shows that the growth has slowed down. Tougher macro and competitive headwinds are part of the reason for this deceleration, as potential customers are cautious with software spending due to near-term uncertainties. And speaking of competition, UiPath is facing heat from major players like Salesforce and Microsoft, who are creeping into its backyard with their own RPA services. Both of these tech giants could also integrate more advanced AI tools to automate tasks, potentially replacing the need for third-party RPA services like UiPath's. To make matters more challenging, UiPath isn't profitable yet, and analysts expect it to rack up net losses of $100 million to $200 million annually through fiscal 2026. Ouch! All that red ink could make it tough to compete with well-established rivals. While UiPath has indeed carved out a niche in the market, it didn't have the luxury of expanding for years like Salesforce did. Unlike Salesforce's brand new cloud-based platform, UiPath focuses on automation bots that integrate into existing software. So considering all these factors, it's still a bit too early to say that UiPath will become the next Salesforce. It might have room to grow, especially with the global RPA market estimated to have a CAGR of 23% between 2022 and 2029 as per Fortune Business Insights. But it has a lot to improve and fierce competition to face. Velo3D – Growth Deceleration in a Soft Demand Environment. Lastly, we've got some interesting insights on Velo3D, an additive manufacturing company that's making waves in the market. They focus on printing high-value metal parts with complex geometries, and their business is growing rapidly. But hold on, there is more to the story. Velo3D is taking on a potentially attractive strategy by targeting mission-critical components for customers. These are areas where the cost of failure is high, giving them a chance to leverage their technology and potentially enjoy higher margins. The market for high-value metal parts is huge, estimated to be over $100 billion, but it's also quite fragmented with no single dominant player. The company believes it can disrupt the high-value parts market with its additive manufacturing technology. Manufacturers are willing to pay a premium for the benefits it offers, such as shorter lead times, cost competitiveness, and the ability to produce complex designs that traditional machining methods struggle with. Velo3D's printers are unique in that they can produce complex geometries without the need for support structures, ensuring better part integrity and reduced post-processing requirements. This is a significant advantage in the additive manufacturing space. They primarily serve industries like aerospace, oil and gas, and power generation, where their technology can revolutionize the production of complex components. Competition is always a factor, and Velo3D is up against some big names like EOS, General Electric or GE, SLM Solutions, Renishaw, 3D Systems, and Desktop Metal. While Velo3D has a differentiated offering with its support-free printing, the additive manufacturing space is still evolving, and the best technology and service provider are uncertain. Now let's dive into their financials. Despite a weak macro environment, Velo3D's customer demand has remained robust, and they're scaling up their business rapidly. Their revenue more than doubled in the first quarter of 2023 to $27 million, and recurring revenue is showing promising growth as well. However, the growth expectations are likely to decelerate in the near future. The guidance for the second quarter indicates that growth is expected to slow down. And while Velo3D aims to improve gross margins through various strategies, the current numbers are low and volatile. Now, when it comes to valuation, the stock looks pricey based on a revenue multiple. However, keep in mind that Velo3D is targeting a large market, and has a differentiated offering, which might justify the premium. Still, investing in an additive manufacturing company comes with risks, as the market historically has had limited growth and struggled with positive free cash flows. The bottom line is that Velo3D is in a rapidly evolving industry with both opportunities and challenges. Their unique technology and focus on high-value applications give them potential advantages, but they face competition and uncertainties in a dynamic market. And that's all for today. Share your thoughts in the comment section below, and if you like this video, be sure to hit that like button and subscribe to our channel for more. Thank you for watching, and we'll see you in the next one.